Hello, welcome to this Moody's Analytics podcast. Today we're tackling one of the most intriguing, perhaps fundamental issues surrounding climate change, and that's its impact on the global economy, and more specifically on asset prices, both in the short and the long term. Now this is a key question, and as we move further into what many now see as the climate emergency, how is that likely to be reflected in asset prices? And are the current models that are being deployed, are they delivering the kind of insight that's required? Now, to tackle this fascinating topic, we've got two eminent observers to help bring some clarity. First, we have Professor Riccardo Rebonato, who is a scientific director at the EDHEC-Risk Climate Change Institute. In 2023, he was awarded the Quant of the Year award, and he holds doctorates in nuclear engineering and solid-state physics, and was research fellow in physics at Oxford, and has also held positions as the head of derivatives trading, head of risk management, and head of research at a number of sell-side and buy-side financial institutions. And most importantly, his current research is on the impact of climate change on asset prices and on the climate scenario analysis. So joining alongside the professor is Nick Jessop. Nick's a senior director at Moody's Analytics, and he's a scenario modelling expert. Nick leads a team of UK-based quant analysts, economists, and financial engineers focused on researching risk management solutions. So two better people we could not hope to find for this particular question. So, Professor, I know this is a big question, but in your view, do current asset prices reflect the realities of the impact of climate change? And if not, why not?
Thank you for the question. The question is really, really interesting and really important. I would say more than impression, but my conviction at the moment is that prices, if they reflect the effect of climate change, they only do so in a very partial way. Why do I think so? Well, there have been lots and lots of studies that have tried to detect whether prices move in response to climate change news, to detect any kind of climate risk premium, and the results are they're what they're called statistically significant. So it's good enough to publish a paper, but economically not significant. And furthermore, if you read one paper, you see, the risk premium is positive, the risk premium is negative. And which makes me think, if a signal is so difficult to detect, it seems to imply that it might be there, but it's really minute, it's really tiny. And from last weekend's FT, there was a title, Oil and Gas Groups Face Virtually No Extra Cost for Borrowing, S&P finds. So this is difficult to reconcile with what we think in terms of a climate emergency. So how can the two things be reconciled? Well, what does the market think? One possibility would be that the market thinks that adaptation and abatement and everything will be so effective that climate change will be a non-issue. We'll be able to manage it very, very well. And the other thing is that you might think that even without doing anything, there will be a soft landing. Let's go to the first one, the first possibility. Even if we manage to control the effects of climate change very effectively, this will have huge implications on the global economy. I could call it a rewiring of the whole economy. So it is not just a matter of installing a few solar panels and wind turbines, or a lot of solar panels, a lot of wind turbines. It's a matter of restructuring the energy production, the supply chain. This should leave very important signals, very important signatures in sectoral differential asset pricing, but we don't see it. That is what is so difficult to see. That is all the good studies have found just a trace. So I'm not saying that it is totally unpriced, but for a complete rewiring of the economy, one would expect a lot more. And then there is a possibility of saying that, perhaps the market thinks that it's not a big deal. So even if we don't do much, the economic consequences will be muted. This is very, very difficult to maintain. And what I would like to stress is the degree of uncertainty about what damages will be is absolutely huge. So admittedly, there are some serious estimates that say the economic effects, I'm stressing economic effects of climate change, might not be very big. Other estimates say they will be disastrous. the range of uncertainty is such that it should be reflected in the prices. After all, what modern finance teaches us is that prices are not just a function of expectations, what we expect the cash flows to be, but also a function of uncertainty. And as we increase the uncertainty, our asset allocation changes, the prices change, etc. And we are not seeing this. So I'm simplifying things a lot. And also, we have to keep in mind that one of the biggest unknowns is what development path currently still to develop countries will follow. I'm thinking, for instance, of Africa. If Africa begins to grow economically as robustly as China did from the 1980s, 1990s, we're going to have a completely different dimension for emissions, concentrations, temperature, etc. And we really do not know whether this development will occur, and if it does occur, whether it will be on the back of sustainable energy sources or on the back of more traditional fossil fuel energy sources. So again, here there is another huge area of uncertainty that doesn't seem to be in the prices. So that is why I think that the markets are very partially reflecting the potential effects of climate change.
That makes sense, and it's a huge topic. And so, Nick, if that was to change, and if the markets were able to begin to accurately reflect some of those likely impact scenarios, and as the professor says, there's an awful lot of uncertainty around them. What do you think that would look like now?
Yeah, it's a great question. And we have kind of worked through this with different scenarios, so we have some sort of idea or some sort of a set of sort of defined views. So I mean, the longer term impacts we expect to see in the markets is a reaction to the increased costs that hit the economy. So what that means is typically a fall in real rates, or what economists would call the natural rate of interest, and an increase in inflation and nominal rates. And those two changes can have quite significant impacts on fixed income valuations. If the changes in longer term earnings and rental growth across the economy are capitalized, we'd also expect to see sort of drops in equity markets of up to 25 to 30%, which is a significant market correction. It's the sort of event which happens every 5 or 10 years. We also would expect to see elevated levels of risk aversion, and that's probably going to be most evident in credit spreads. And what makes these kind of scenarios different, or these kind of market adjustments different to a lot of historical events, is there's likely to be less of a recovery afterwards. And that's particularly so if the markets are adjusting to a lack of policy action on climate and pricing in the longer term physical climate damages that you expect to see if we continue to emit greenhouse gases and we continue down a path of global warming.
Okay, and so what is? I mean, a lot of this is focused, or I suppose there's been a lot of focus on how stress testing can kind of address this. But in terms of the current sort of stress testing regime, if you like, it's a broad question, but is that fit for purpose, do you think? Do those scenarios and those models, do they focus on the right areas, and do they capture the true impacts?
Yeah, so to date, I guess regulators have largely steered away from labeling the sort of climate scenario exercises that they've been doing as stress tests. They have preferred the term exploratory exercises. And part of the reason for that is they're often long-term in nature, and they miss out sort of short-term business risks like sort of market stresses. A couple of notable exceptions to that would be the inclusion of a delayed transition scenario in these exercises, which has a Minsky shock as climate policy is introduced, say in 2030 or 2028, 5 or 10 years down the line. And also, the Bank of France did a short-term stress test exercise last year focused on climate risks. If we move away from regulatory kind of exercises and we look at what industry is doing, in insurance, we see a lot of focus on what's known as ORSA, which is the own risk self-assessments. And there, the natural approach is definitely short-term stress testing. And we have seen organizations like the Network for Greening the Financial System, the NGFS, has started to publish shorter-term narratives that they say they will quantify next year and could be used as the basis for stress testing. Many of these exercises are still event-driven, but market risks, sort of this that Professor Rebonato was talking about, and market shifts are likely to be very important components of any of those kind of exercises and analysis.
Absolutely. Professor, do you want to come in on that?
No, I completely agree. There are a few comments which I think are very important. The creators of the narrative, the SSP and the RCP narratives, they can call them whatever they want. But what is important is how they are used and what interpretation is given to this. Now, these narratives and these representative carbon pathways were not created with investors in mind. They were created with policy in mind. And the two things don't overlap very, very easily. From a policy perspective, one could argue that one should follow what we call a precautionary principle. From the point of view of investing, there is no safe way to be wrong. So whether you assume too aggressive, too optimistic, or too pessimistic a scenario as your central estimate, you're liable to make big mistakes if you get it wrong. So a recognition of the probability of a different outcome, which is completely missing from the present architecture, is essential in order to draw reasonable investment conclusions. Also, I think it is very misleading that, for instance, in the NGFS case, many users of the NGFS produced scenarios do not realize that they have all been bolted on top of what is called the SSP2, which has as a label following the main road, which means everything chugs along pretty much in an uneventful and reasonable way, which, yes, it could very well be the most likely outcome, but it gives absolutely no idea of what might happen in the tails, in the good tails and in the bad tails. And furthermore, there is another misconception about the narratives, that as long as I apply suitable weights to the different narratives, I have a distribution of events. That is not true, because the narratives do not cover at all the possible combinations. In particular, the conspicuously missing one is a technologically driven green transition with strong GDP growth, which is a plausible and possible scenario, a possible narrative, which is not just an example in the set of narratives. So there are a lot of misunderstanding. The quality of the work that went into creating these scenarios is excellent, but they were creating with different purposes in mind. And the moment they are uncritically used by investors, they can be not fit for purposes, and I would say more, they could be dangerous, especially in their lack of communicating uncertainty around the central estimates.
So what needs to improve then? It's interesting that because I know you've done work on the way in which markets are kind of lagging behind the realities here, and that markets tend to be a sense of being asleep at the wheel a little bit. So what needs to happen for the market to start accurately reflecting some of these scenarios then?
Well, the market and investors, so it's not necessarily the same thing. So I am obviously in no position to convince the markets of what they should be paying attention to. But if a long-term strategic investor came to me and said, what should I focus on in my analysis of climate change? The first and foremost thing that I would say, take into account, one, the relative likelihood, approximate as it might be, of the different outcomes, and the huge dispersion. Both these dimensions are missing at the moment. And as I said before, from the investment point of view, it makes a big difference to my investment choices if I base my allocation on the central scenario, or if I say around this central scenario, I have two very diverging possible outcomes, my portfolio changes dramatically.
That makes sense. So, Nick, the professor mentioned the idea of a green transition and sort of green growth, I guess, which is one of those scenarios that's been sort of posited as being one of the, I guess, one of the more optimistic scenarios. Do you think they've been adequately understood and modelled?
Yeah, it's a great question, and they're absolutely central to some of the other initiatives in the financial sector that we've seen, like the establishment of the sort of cross-industry GFANZ group, the Glasgow Financial Alliance for Net Zero, that was set up following the Glasgow COP. However, as Professor Rebonato has said, green growth has been a pretty glaring omission in much of the scenario work that people have done in finance. Only very recently has the NGFS included elements of a green growth narrative in one of the shorter term scenarios. I think it's called the Pathway to Paris. And scenario analysis, it's important to realize scenario analysis doesn't have to be risk downside focused. In fact, it shouldn't just be risk or downside focused if you're concerned about asset allocations, as Professor Rebonato points out. It's possible to incorporate green growth dynamics both in the later stages of a long-term transition scenario, because as you move towards a net zero economy, you expect green growth to emerge, but also earlier on, if you include things like productivity multipliers in the broader macroeconomic impacts that you're modeling. And that happens typically as a response to significant abatement spending and significant levels of investment in R&D that you see early on in a transition scenario.
Professor, how confident are you that type of work is going on and those kind of scenarios are being adequately understood and utilized, I guess?
Yes, I think there is a widespread realization, or it's the burgeoning of the realization that the scenarios are not suitable for investment purposes. And for instance, I would like to point in one very important point that is missed, sorely missed. We have done a lot of work, and we are, as it were, looked under the bonnet or under the hood, depending on which side of the Atlantic you are, to see how these things actually work. And as you know, with the narratives and the carbon emissions, the two are matched by in these approaches by determining the carbon tax that makes one compatible with the other. Now, very people know that in certain combination of scenarios, the implied carbon tax rises to 70-80% of GDP. Now, to put things in perspective, we currently spend 3% globally on education, 3% on defense, and 8% on healthcare. So the realism of a scenario that predicts that 70% of GDP will be spent on abatement is very dubious, but this is hidden. So the user, the poor user, has no idea that this combination of SSP and RCP is virtually impossible. And that is what that's what I mean when I say we must give a broad idea of the likelihood of different scenarios, by which I do not mean a sharp probability as VAR promises to do with a 99.975, etc. But just to say, well, this is 10 times more likely than this, or this is really almost impossible. This is something to spend your analytical attention on. I think that it is very, very important. And it is missing. So many of the other implications or assumptions behind these scenarios are completely lost on the users. And therefore, they just consider them equally probable, or, well, I don't know. I can't know in detail how they're used, but the way they're presented, they can't be good. So yes, indeed, we are doing in my research group a lot of work exactly in this direction.
That makes sense. Nick, I know you've been sort of immersed in all this sort of stuff. And one of the things that sort of came out from some of the work you've done is this idea of GDP and the way in which that's sort of used as a yardstick, maybe, in terms of the likely impact of some of these climate change scenarios. Do you think that's a useful comparator? I mean, is it time perhaps to start looking at other indicators away from GDP in terms of the way in which this is going to impact things?
Yeah, I think undoubtedly focusing on GDP means you miss a huge set of dynamics. And the reason for that is that when you look at all of the costs that are involved in dealing with climate change, whether it's transitioning or dealing with climate damages, those are typically modeled as what economists would call opportunity costs. And GDP is an imperfect measure of economic activity because the G in GDP stands for gross, which means you don't really adjust for a lot of those costs. And in particular, you're not adjusting for kind of lost opportunities or write down in capital values. So what we encourage people to do is look at primarily the costs themselves and understand that they will impact below the high level GDP levels. And this is really this can be very misleading for people because often the denominator that's used when people look at damages or costs is GDP. That doesn't mean the impact is on GDP. GDP can actually hold up quite well because it's usually used as a measure of productivity. So I guess one way of kind of trying to summarize this is that when you look at these scenarios, generally people are going to be employed, but they might not necessarily be employed in productive or useful ways. So we tend to focus actually more on sort of net measures of economic activity, and one of the obvious ways of doing that is to look at consumption and consumption growth when we're doing our modelling.
I can see you're nodding along enthusiastically there,
Yeah,
Professor.
no, absolutely. It is gross GDP after costs and after damages. That matters. Yeah, absolutely.
Yeah, that makes sense. And so, Nick, what's the Moody's response to all of this then? Because you're in the front line of this, working with clients and helping them out. I mean, what are you doing to sort of help clients better understand these scenarios that are coming down the pipe?
Yeah, so I mean, we're encouraging clients to go well beyond looking at just two scenarios to be analysed. In some of the guidance, you're told to look at one scenario below 2C and one above 2C. But when you're exploring the problem, the truth is, as Professor Rebonato has pointed out, there's a huge degree of uncertainty to navigate. And that really only reveals itself when you start looking across and between different scenarios, and when you start trying to evaluate the plausibility of these different scenarios. So there may have been, I think, too much early focus in the financial sector on detailed data and modelling exercises, and that's something which Moody's can certainly help with, and they are important. But all that effort can be of limited practical use if the broader context isn't well understood and articulated. And to summarize, I mean, what I sort of say is systematic and systemic risks and opportunities are often the most impactful changes for businesses to learn to manage.
Professor?
I would simply, I completely agree. I would simply add to this that there has to be what I would call a pull and push. So, yes, the academic community and the policy boards, etc., have to provide better scenarios. However, there also has to be a different type of engagement from big institutional investors. I have sat on investment committees and I have fed information into investment committees. And I know by experience that when the board member has a dashboard with so much information, the thing that he asks for, give me one number, please give me one number, give me the VAR, give me the Sharpe ratio. Unfortunately, in the uncharted territory in which we are venturing with climate change, this type of approach cannot work. So black boxes, if they ever worked, they cannot work now. And this requires, therefore, also a more inquisitive and a deeper engagement, which is uncomfortable from the point of view of pension trustees, of sovereign wealth funds managers, or portfolio managers, etc. And this is a big change. And it is a big change. But as I said, it has to be pull and push. And it is not believable that we can make synthetic the enormous uncertainty, complexity, and uncertain nature of the outcomes with one number, one statistic, we have to talk, we have to discuss.
And how optimistic are you about about that level of engagement, that type of engagement, the quality of engagement? Are there any Are there any historical examples that you could point to and say, well, this has been done before? I mean, obviously not to this magnitude, but does the investment community tend to grab that
It's
opportunity?
really difficult to say because we are truly in uncharted territory. So, what do I mean by that? We have not experienced a changing environment of this type as we are facing. So, investment professionals say, "Oh yes, I've seen it all. I have been around the block for a few decades. I know. I was there in '87, etc., etc." So people say, "I can go back to my expert knowledge, to my institutional experience, etc., to fill the gaps of the information myself." But if I tell a decision maker, consider the possibility of 200 basis points increase in rates, she or he immediately will say, "Yeah, I know what you're talking about." But if I tell the same decision maker, consider the possibility of a radiative forcing of 8.5 or 4.5, the person say, "What are you talking about?" And I have no idea, even if she does know what forcing is, she might say, "I have no idea how to assess whether one is to be taken more seriously than the other." Therefore, and then you're asking, when will the change occur? Occurs, unfortunately, tend to happen only after something bad has happened. So, and that is so, which brings us in a way full circle. We started from asleep at the wheel. When will markets stop to be asleep? What will be the wake up call? Is extremely difficult to tell. Some people talk of a Minsky moment. I don't know if the term is correct, but it is certainly attention grabbing. Probably, potentially, what would have to happen would have to be a high profile event. Possibly, I'm thinking what could be a catalyst for attention grabbing, something hitting a big urban center in the West. Unfortunately, our attention is very selective. And if terrible things happen in the global South, we shrug it off. But if something happened in a big metropolis like New York or London, then that could be the catalyst to say, oops, we have to look at this differently. And obviously, I'm not hoping for this to happen. I hope that it will be a more mature way of updating valuations. But if you were to ask me, in the short to medium term, what could bring about a revaluation of the risk, I think a catalyst is needed. And without this catalyst, this misvaluation, if I'm correct, I think can go on for a long time. And trying to catch a falling knife, as people who've been in the market know, is extremely difficult.
Absolutely, Nick. If you want to kind of wrap us up there a little bit, I mean, what's your take on what the professor just said there? It's it's a serious
I mean,
time.
I'm pretty optimistic because the way I would judge this is if we see significant changes in asset allocations that these bigger institutes are holding, then that's what's needed, and that would be a sign that they are responding to the kind of risks that they see. And I guess the reason I'm partly optimistic is I've seen that in my own career happen 2 or 3 times. So, within the pension sector in the UK, there was big significant changes in the way they allocated assets in the late 90s. In insurance, big changes in the early 2000s, and following the financial crisis, there's also been some changes in the banking sector. Most of those are focused on risks and risk reduction, but I do think they are good examples of how the industry can respond. So I think part of the reason why I am, I guess, animated by this and focused on this is because I genuinely do think we can kind of respond, and the industry can respond, but it probably does need something to drive that, like regulatory change or just the way that the whole industry focuses on things.
Absolutely. Professor, have you got one more point there before we wrap
Just
up?
very, very briefly, I really agree with Nick, but I would like to make a point that one must draw a sharp difference between asset allocation and reflection in prices. So, a colleague of mine, Raman Upal, has written a very, very nice paper showing that it is possible to have a big shift into ESG or climate, by screening or whatever, without necessarily this having, just because of the changing preferences, an impact on prices. So the two things are not as closely linked, and it's a bit of a technical point. It depends on what is the production function for the different. You should have this discussion with my colleagues. It's fascinating, but allocations and prices is quite different, and we have to keep that in mind. It's not automatic, because the moment a climate conscious investor sells shares in the sinful, the climate non-conscious investor sees a bigger expected return, a bigger risk premium, and buys it up. So it is a complex dynamics that has different possible solutions. So allocations are different from prices. And if we are focusing on what is the impact on prices, we shouldn't take as given that big allocations cause big changes in prices. After all, the fact that we are not finding a difference in the cost of funding is just the expected return. So it means that the market is, at the moment, for Orca, is not impounding a big change in expected returns.
Absolutely. Okay. Well, I think that's as good a point to wrap it up as any. It's a fascinating conversation. It's one that's going to run and run, clearly. For now, though, it just leaves me to thank my two guests, Professor Rebonato and Nick Jessop of Moody's Analytics, for their time. Fascinating conversation. Thanks very much to you both. And also to thank you all for listening. I hope you found that an illuminating and useful half an hour. So thanks very much. Goodbye.
Thank you.